The market is currently open, and right now Navitas Semiconductor is trading at $11.43, down 2.72% during today's active intraday session. While mainstream retail media wants you to believe this is just another minor macro headwind hitting speculative small-cap tech, the underlying reality is far more disruptive to long-term shareholders. Beneath the surface of this intraday slide lies a massive structural pivot away from its legacy consumer markets that initially built this company, compounded by a freshly initiated $500 million at-the-market equity issuance program and an active, heavy-hitting patent lawsuit from Wolfspeed that directly targets the company's signature power chips. The typical expectation for this stock has always been straightforward. It is a high-growth, wide-bandgap chip designer perfectly positioned to capture the next massive wave of energy infrastructure, data centers, and electric vehicles. Retail traders look at the massive expansion of artificial intelligence facilities and assume every single next-generation power chip firm is an automatic winner. The reality, however, is a complex narrative of falling short-term revenues, high operational cash burn, and severe shareholder dilution risks that are forcing institutional desks to reevaluate their positions entirely. Let us pull back the curtain on the immediate trading dynamics before looking at the bigger long-term picture. Navitas Semiconductor has seen highly elevated trading volumes over the past few sessions, frequently breaching its multi-week average as institutional rotation shifts out of high-multiple growth equities. Today's price action highlights the massive battleground raging between short sellers who see structural weakness and long-term tech bulls who believe wide bandgap infrastructure is heavily underpriced. What is really driving the sharp movements in recent weeks is a direct clash between expectations and financial reality. The broader narrative around high-efficiency power semis is incredibly bullish. Everyone knows that conventional silicon chips are hitting a physical wall when it comes to heat dissipation and high-frequency power management. This expectation drove significant momentum into the stock, lifting it toward historical highs during previous market expansions. But the financial reality delivered to the public has been vastly different. Looking closely at the recent quarterly filings, the numbers show a top-line revenue decline that caught casual observers completely off guard. Total revenue dropped from over $20 million down to under $9 million in the most recent periods. For an investor using traditional individual brokerage accounts or exploring general online investing platforms, seeing a growth stock experience a massive drop in revenue is an immediate red flag. The reality is that the company intentionally walked away from nearly 60% of its previous revenue baseline by exiting the hyper-competitive low-margin mobile and consumer fast-charging segments in mainland China. They chose to pivot into high-margin enterprise data centers, solar arrays, and automotive systems. While that shift makes strategic sense on paper, it has left an enormous financial gap that the newer industrial segments have not yet grown fast enough to fill. This brings us to the core issue affecting today's trading action: the severe balance sheet pressures and the mechanisms management is using to survive this transition. When you're looking for investment help or mapping out your self-investing strategy across major platforms like Fidelity, SoFi Invest, or Interactive Brokers, you have to watch cash burn like a hawk. Navitas recorded a deeply negative net income margin in its recent reports, bleeding cash as it expands research and development for its newer platforms. To combat this, they opened up a $500 million at-the-market equity program. For existing retail shareholders, this is an incredibly bitter pill to swallow. It means that even if the company successfully scales its high-power chips in the coming years, early investors face significant dilution as new shares are continuously pumped into the open market for funding operations. This supply overhang acts as a heavy ceiling on the stock price, which explains why the asset has been sliding despite broader tech sector tailwinds. Institutional funds utilizing complex tools on the Interactive Brokers platform or managing massive allocations through Fidelity Wealth Management have clearly adjusted their risk models to account for this dilution risk. The technical chart reflects this perfectly, showing a series of lower highs and a struggle to maintain solid solid support levels whenever the broader market faces a minor correction. Comment below how many shares of Navitas Semiconductor you currently hold, or if you prefer keeping your capital in large-cap hardware leaders instead. To truly understand if this business can bridge the gap between its current losses and its future promises, we need to examine what they actually build and how their model operates. Founded in 2014 and operating as a fabless chip designer, the firm focuses entirely on next-generation power semiconductors made from gallium nitride and silicon carbide. In plain English, these materials allow electrical systems to convert and manage electricity much faster, with significantly less heat loss and in a fraction of the physical space required by traditional silicon. Their flagship product families are designed to be integrated directly into high-power applications. By utilizing a fabless business model, they avoid the multi-billion-dollar capital expenditures required to build physical manufacturing plants, choosing instead to outsource the actual fabrication to global foundries while keeping the highly valuable intellectual property in-house. This strategy was wildly successful during the initial wave of mobile fast chargers, where their technology allowed smartphone companies to deliver miniature wall breaks capable of charging a phone in minutes rather than hours. However, the mobile accessory space quickly turned into a commoditized price war with razor-thin margins, prompting the massive strategic pivot we are witnessing today. The new operational focus is heavily directed toward the artificial intelligence infrastructure boom. Modern data centers packed with high-end graphics processing units consume an astronomical amount of electricity, and traditional power supplies are incredibly inefficient at managing these intense, continuous electrical loads. Management has aggressively pushed their newer integrated architectures into these next-generation server architectures, collaborating with major system builders to get their components designed into the core power supply units. This is the expectation that keeps many long-term bulls fiercely loyal to the asset. They look at the massive demand for power in computing facilities and assume the business will inevitably scale into massive profitability. But the near-term reality is complicated by intense legal battles. On July 7th, Wolfspeed officially filed a major patent infringement lawsuit on Navitas Semiconductor in the United States District Court of Delaware. The lawsuit explicitly alleges that their core wide bandgap product lines infringe upon 5 distinct patents held by Wolfspeed. While management immediately shot back, completely disputing the claims and promising an aggressive legal defense, a patent lawsuit from an established industry peer introduces a massive layer of binary risk. Legal battles in the semiconductor space are notoriously expensive, slow, and unpredictable. If the court rules against them, it could lead to costly injunctions or expensive licensing agreements that would completely crush their projected margin recovery. This brings us to the forward-looking scenarios and how investors should navigate the structural gap between today's grim financials and tomorrow's massive market opportunities. The ultimate bull case relies entirely on the successful execution of their industrial ramp-up. If the company can secure massive design wins within upcoming electric vehicle platforms and global data center deployments over the next 12 to 18 months, the top-line revenue recovery will begin to outpace the rate of equity dilution. There are early signs that this could happen, as sequential revenue from the latest quarter showed a modest uptick compared to the previous quarter, indicating that the absolute bottom of the consumer market exit might finally be behind them. However, if the data center qualification cycles take longer than expected, or if automotive manufacturers delay their next-generation high-voltage electric vehicle architectures due to slowing global consumer adoption, the business will be forced to draw heavily on its $500 million equity program, which would continually dilute current retail investors, turning what looked like a high-growth tech play into a prolonged value trap.
When you sit back and look at the entire landscape through popular apps like Robinhood or review long-term asset models through an automated intelligent portfolio, the lesson here is all about managing the friction between market narratives and cold, hard execution. The expectation told a beautiful story of a small-cap chip designer riding the coattails of the global electrification and artificial intelligence booms. The reality revealed a company burning through capital, diluting its base, and facing a massive legal threat from an aggressive competitor, just as it tries to rebuild its revenue from scratch. For the sophisticated investor, today's 2.72% intraday drop is not just random market noise, it's a direct reflection of a high-stakes transition where the room for error has completely vanished. Whether you're actively trading this asset or looking at broader artificial intelligence trends, keeping a close eye on the upcoming quarterly numbers and the progression of the Delaware patent suit will tell you everything you need to know about whether this company can ever truly match the massive expectations the market has set for it.